Hi everyone, Kathleen here, Research Director at XTB. Risk sentiment is back on this week after the Federal Reserve in the US was less hawkish than expected and the April US payrolls report was much weaker than expected. European stocks are following US and Asian stocks higher. The UK's FTSE 100 is the top performer in Europe in the last week. It's a big week for UK assets. On Thursday, we have the Bank of England meeting, and then on Friday, we have a major data release, including the first reading of Q1 GDP. The Bank of England is not expected to change policy at this meeting, and rates are expected to remain at 5.25%. However, the market is expecting a rate cut from the BOE in June, and we expect the bank to use this meeting to lay the groundwork for the first rate cut. There's now an expectation that the ECB and the Bank of England will both cut interest rates in June, while the Federal Reserve in the US will cut rates later this year. The Bank of England might prime the market for an interest rate cut in June. The rhetoric from some BOE members has become notably less hawkish in recent months. The vote split in the 9-person MPC who vote to set UK interest rates is also worth watching on Thursday. We could see 2 members vote for lowering rates, while 7 members vote for rates to remain unchanged. This would suggest that momentum is moving towards an easing bias at the Bank of England. A rate cut in June is dependent on inflation falling sharply in April. We won't find that out until May 22nd. However, the Bank of England expects the April CPI data to fall back to 2%. Added to that, Friday's UK GDP is expected to show the UK economy emerging from its shallow recession at the end of 2023. The economy is expected to have grown by 0.4% in Q1, boosted by government spending and consumption. Now, in terms of UK asset prices, the pound is down a touch versus the USD in the past month, but overall sterling has weathered the stronger dollar well. Added to this, the pound is also stronger versus the euro in this period. The FTSE 100 is the top performer in Europe in the past month, and the index is higher by more than 4%, led by Anglo-American, AstraZeneca, and advertising giant WPP. UK asset prices are getting more attractive in line with the prospect of a UK rate cut. Currently, the market expects just over 2 rate cuts this year from the Bank of England. Whether or not this happens could depend on the BOE's latest growth and inflation forecasts. If the BOE cuts their inflation forecast for the rest of this year and into 2025, then it could signal that the market is underpricing the prospect of UK rate cuts, which would be bad news for sterling, but may boost UK stock prices. However, wage growth remains sticky at a 6% annual rate. So even if the BOE does lower its inflation forecast, they might temper this with concern about wage growth, which could limit the scope for rate cuts down the line. In the long term, UK interest rates are unlikely to return to pre-COVID norms. We will be listening to the BOE to see if they give any clues about the terminal rate. While the bank is unlikely to commit to a terminal rate, they might hint that any rate cuts will proceed at a cautious pace due to the residual inflation pressures and the threat from wage inflation. That's it for now. Thanks for joining.